Welcome to a bracing conversation with one of Wall Street's great skeptics. On this episode of Richer, Wiser, Happier, William Green sits down with Jim Grant, the financial historian who has edited Grant's Interest Rate Observer since 1983 and who has spent more than 4 decades reading markets through the long lens of history. Grant has a track record of early warnings: the dot-com peak in 1999, the mortgage dangers before 2008, the inflation that Fed policy would eventually unleash. Now he sees the theater of a major market top being set across stocks, Bitcoin, and gold alike. What follows is his case, laid out in full, along with his hard-won lessons on debt, inflation, private markets, and temperament. As always with talk of specific assets, none of this is investment advice. It's one contrarian historian's reasoning, offered so you can weigh it yourself. A major top in the making. Grant is careful to distinguish his stance. People say we're always bearish. That's not actually true, but we are almost invariably skeptical. And what he's skeptical of right now is a mood. He describes the moment in theatrical terms. The whole theater of a major financial markets top is on the stage, with the scenery, actors, and script of top-making all in play. The tells are the classic late-cycle ones: stretched valuations, giddy sentiment, unmistakable corrupt promotion, and the swagger of newly rich people who know only that markets go up. He is emphatic, though, that a top is not a timing signal. Does it have to end now? Or in 2 years? No, but it will. His discipline is not to sell everything and hide in cash, but, echoing Howard Marks, to prepare for an uncertain future, to ask whether you're carrying too much leverage or too much in overpriced, speculative assets, and to take risk thoughtfully rather than blindly. U.S. stocks at historic valuations. The hard numbers under the mood are stark. The S&P 500 trades at more than 40 times its cyclically adjusted price-to-earnings ratio, the Shiller CAPE. To anchor that, Grant notes the CAPE was 38.6 in the fall of 2021, and that today's reading is the richest in history except for the dot-com bubble, when it hit 44.2 in 1999. Concentration compounds the risk. The Magnificent Seven now account for about 31% of the entire S&P 500's capital spending, up from 19% at the end of 2019. Grant is careful to calibrate the warning to the listener. A 20-something with a diversified portfolio and decades ahead can reasonably ignore him, because over the long run America tends to prosper. But an older investor heavily exposed to stocks, he suggests, might want to attend to the signs of excess, which are, in his phrase, at every hand. The AI capex contest. At the center of the excess is the AI build-out. Grant cites figures showing that a handful of giants, Amazon, Microsoft, Alphabet, Meta, Oracle, and CoreWeave, will spend roughly $382 billion in capital expenditure this year, up more than 50% from 2024 and triple the level of 2023. On top of that sit private labs like OpenAI and Anthropic, raising billions every few months at valuations in the hundreds of billions. Grant has called it a check-writing contest, in which everyone races to invest as much as possible, as fast as possible. His concern isn't whether the technology is real. It plainly is, but whether the spending will ever be paid for, and whether the sheer scale of redundant investment is a symptom of mania rather than sober calculation. Echoes of railroads and fiber. This is where Grant's historian's instinct takes over, because he has seen this movie before. The AI capex contest, he says, rhymes with the fiber optic build-out of the late 1990s. How much do you lay in the ground, and is there demand for it? And, further back, with the great railroad building contests of the 1800s, where companies laid track parallel to their rivals, and the boom ended invariably with a panic and a crash, as in 1873. His deeper point is about human nature, not silicon. I hear myself saying, "I'll get a horse," in 1903. He jokes, the skeptic scoffing at the automobile. The specific worry he credits to an early NVIDIA insider is a demonstrated gap. Enormous data centers rising, one reportedly the size of Manhattan, yet customers so far unwilling to pay enough for the product. His unsettling question is whether the payday comes with the promise fulfilled, or whether there's going to be a crash first, before the technology's real rewards arrive. The debt reckoning. Grant's oldest theme is debt, and the numbers he marshals are sobering. Global debt, he notes, rose from $16 trillion in 1980 to $314 trillion in 2024. U.S. federal debt, from $1 trillion to $37 trillion over the same span. His line captures it. It took the U.S. 222 years to borrow what the efforts of Presidents Biden and Trump achieved in not quite 8 years, a deliberately bipartisan indictment. The complacent case says the dollar is the world's reserve currency, sought after like a great brand, so there's effectively no limit. Grant's rebuttal is that the burden of interest and the sheer weight of issuance will eventually exhaust even America's friends, and he points to warning flickers already. The 2019 repo squeeze, the March 2020 treasury market dysfunction. His real question is the demand for U.S. securities at these yields. Are they marketable at any rate? And he flags the deeper danger, that America is running 6 or 7% deficits in a booming economy with low unemployment, which is not how well-managed public finances behave. Inflation and the Fed. Grant roots inflation in human nature, quoting the mid-century economist Wilhelm Röpke, who described it as an economy's reaction to a presumptuous overconfidence, wanting to invest more than savings permit and to draw bigger checks than the economy can honor, until money itself, the sensitive organ, is enfeebled. The permanent damage is the point. The dollar never regains the purchasing power it loses to inflation, a line he draws from the long-serving Fed chairman William McChesney Martin. Under a gold standard, overissuance corrected itself. Under a fiat reserve currency, there is no hard limit. Grant is a career Fed antagonist. He can't stand the adage, "Don't fight the Fed," and his sharpest current worry is political capture, an administration bent on ultra-low rates and a subjugated central bank, which he thinks would deliver a much weaker dollar and a much steeper yield curve. And he insists ordinary people feel the price level, not the rate of change, hence a decadent detail he can't get over. A skimmed cappuccino and blueberry scone in Westchester running him $21. Bitcoin, the most efficient price, is 0. On Bitcoin, Grant is unsparing, and he knows it's cost him television invitations. With the coin near $116,000 and the whole crypto complex worth more than $4 trillion, his verdict is unchanged. The most efficient price of Bitcoin is 0. He simply doesn't understand the utility. You can't see it. And he questions what you'd actually use it for, likening the mania to a limbic system reflex of monkey see, monkey do as the chart climbs. He found the most lucid critique in a lecture by an early NVIDIA computer scientist, who noted that roughly a fifth of all Bitcoins are already lost, and that a future quantum computer might crack the keys, and whose killer line Grant loves. Rarely, if ever, in the annals of technology have the champions of a breakthrough technology gone to such pains to not use it. He's also disturbed by the promotion, an administration, all in on crypto, and the conflicts around presidentially branded coins, which he calls contemptible. Gold, money simple. Gold is the asset Grant loves, and here too he's disarmingly honest about his own fallibility. With gold knocking on $4,000 an ounce, and up some 40% on the year, he tells the story of buying his first Krugerrand in January 1980, essentially at the all-time top, and wearing that mistimed purchase as a badge of constructive humiliation, a check against anyone crowning him a gold guru. He warns that gold moves in long cycles, recalling how it peaked above $1,900 in 2011 and then fell for years toward $1,200, while mining shares lost 90% or more. His bull case rests on the world eventually demanding fiscal reform and some monetary role for gold, but he flags that this is a narrative he's telling himself. What he likes is gold's simplicity. It is deficient in one thing only. It pays no interest, which is also one of its great virtues. It's money. And tellingly, he notes public participation is still muted, not yet the frenzy that marks a true top. Private equity and private credit. Grant turns a hard eye on private markets, and this is where his warning is most pointed. Some 20,000 private equity-owned companies worldwide, he argues, were capitalized for an era of very easy money. When rates normalized after 2021, their valuations became precarious. The deeper problem is honesty. Private equity sold institutions the promise of avoiding the unreasonable volatility of public markets. But that smoothness comes from stale marks. Assets carried at unreasonably high prices that aren't returning the cash investors need. Now endowments and museums that budgeted for distributions aren't getting them and are dumping stakes into the secondaries market like you sell a used car. His favorite line from a speaker at his conference is a rule for the ages. In finance, whenever you hear the word democratizing, hide your wallet. The industry that once wore bespoke suits and shunned the common man now markets private credit to retail, like Chanel marketing itself to Walmart, which Grant reads not as benevolence, but as a sign of desperation. Smart money isn't that smart. A recurring theme is that raw intelligence is no protection. Grant tells the story of the physicist-turned-quant Emmanuel Derman, who after the 1998 collapse of long-term capital management, a fund run literally by Nobel laureates, realized on a call how much better LTCM's principals understood valuation and hedging than his own colleagues at Goldman, and yet they still blew up. The lesson is that sheer mental power is not the road to riches. Grant extends it to the more than 1,000 PhD economists at the Federal Reserve, who nonetheless failed to foresee that zero rates plus massive stimulus would produce both a bubble and inflation. Brains aren't everything, he says. The takeaway for investors is humbling. Don't assume the sophisticated money is protecting you, because its historical record often shows maximum aggression at moments of maximum risk. Temperament, history, and what to do. Grant closes on temperament, which he thinks matters more than any forecast. He corrects a myth about his first biographical subject, the speculator Bernard Baruch, who did not, in fact, sell at the very top in 1929, but took the measure of things in 1930 and got out with most of his capital while buy-and-hold investors were wiped out. He reminds us the Dow didn't reclaim its 1929 high until 1954, a quarter-century later. He quotes Bill Miller's unsettling truth. There is no certainty, it's all probabilities, and warns that investors who've never had their face ripped off in a bear market are the most vulnerable. He even welcomes the pain of being wrong, because markets are the great disciplinarian. Nothing succeeds like having your head handed to you as a learning tool. His practical counsel is not panic, but thoughtful risk-taking. Some gold, some bonds, real diversification beyond the U.S. market, held with humility. And for all his warnings, he ends warm, echoing Charlie Munger that at his age, it's a delight to be anywhere. The final word is a reminder that fits the show's title. Most people, in the end, are about as happy as they make up their minds to be.